Hi, my name is Liz Thompson, and this is a video for IME 315, Financial Decision Making for Engineers. This particular video is on Introduction to Accounting and the first look at financial statements.
So if we review the things that I'm covering in this class, which include investments, reporting and managing profits, cost of products, and looking at all of that within the context of social, political, and economic context, and then also personal finance decisions. This particular video, we're going to be talking about reporting and managing profits. So understanding accounting, which is the method that companies use to record and understand the flow of money in their institution. So there's a couple things about accounting that I want us to keep in mind. The first is that accounting is historical. So it doesn't actually look forward to what's going on into the future. It actually only looks backwards. So we're only going to be looking at stuff that happened in the past. It's not a forecasting method. It's just a recording method. And it's also only measuring money. So it doesn't include anything associated with something like quality or people that were working for you or anything like that. It's just money. There's also, it is governed by FASB and GAAP, which are two methods that lay out the rules associated with accounting. And so there's accounting rules that need to be followed. We are not going to dive into that, but we need to know that there are and that there's standards in this area. It's also related to an entity. So the question is, who are you doing the accounting for? So in this case, I kind of have a picture of a person and a business. And the person might own the business, but defining who it is that you're doing the accounting for is important. So in the case of a business, we would draw the boundaries around the business as opposed to the person who owns the business and do the accounting for that. Now, what that means is that if a person gives money to a business, maybe they lend them money or maybe they buy ownership in the firm, what happens is the firm increases cash and increases also an ownership from someone outside of the company. Now that's opposite. The decrease in cash especially is opposite for the person. The person decreases cash while the entity increases cash. So understanding the entity that you're doing the accounting for is very, very important. Also, these transactions you record these transactions only when they occur. So not something you're going to do next year, but only in the moment that they incur. And you usually do this for a period, maybe a year or a month or a quarter, but things are recorded only when they occur. Now, there's two types of accounting. One, the financial accounting and managerial accounting. So generally, financial accounting are those that are external to external users of the accounting information, and managerial accounting are internal. So externals would be stuff like the creditors, tax authorities, investors, or customers. The internal are management and employees. Now you can see there's some disclosure information, like people within the company can know more detail and more understanding of processes than people external. But externals are concerned with things like ownership and exposure in financial situations, where managerial is more concerned with operations. So they're very similar kinds of recording, but the reports are quite a bit different in detail. Now, some of the reports that are used for financial accounting are also used for managerial accounting, especially the first two reports. So I'm going to go through these three reports and talk about generally what's in them and how to think of them. There's also three other videos that are related to each one of these reports or statements. So the first one we're going to look at is balance sheet, which is also known as a statement of financial position. So this balance sheet is for Apple. And Apple has the balance sheets reflected here. And one of the things we need to notice initially is that these numbers are in millions. Okay, so 900 is the first number. If we look at this first value right here, it's 25,913,000,000 because that value is in millions. So just knowing that the scale of this for Apple Corporation. In addition, all balance sheets are moments in time. So this is a snapshot in time on September 29th, 2018, which is the end of Apple's fiscal year, which is the end of September, and which is a little bit unusual. It's different than an annual year, which is usually thought of as December 31st. Apple's is September 29th. So looking at balance sheets are a moment in time. Also listed on a balance sheet are all of the assets of the company. So in this case, we have listed the cash, marketable securities, accounts receivables, inventories. There's other things like property, plant, and equipment. There's also some things like other that would be spelled out in their annual report, what exactly is in there. But for our purposes, this is all of the things that Apple has in order to make a profit for their company. Now, the other side of that is they list also liabilities for the company. So when we think about liabilities, one way to think about it is it's the debt that the company owes to lenders. The next thing is equity. So the equity is the owner's share of the company, the owner's share of the assets. So when we look at a balance sheet in general, we're going to be looking at these three areas. In addition, also, we need to remember that the general accounting equation, which we'll go over in the video on balance sheets, is assets is equal to the sum of liabilities and equity. So you can see on the bottom of any balance sheet, they'll list the assets, and then they'll also list liabilities and shareholders' equity. Those items are going to be always equal. The next thing we're going to look at is income statements or net earnings or statement of operations consolidated. There's many, many ways of saying this, but it's really what is the profit for the company. Now, again, this is Apple Corporation looking at their profit for each of a 3-year period. So one of the things we need to also remember is that the profit is listed by first looking at the year position. So for a year period, it's as opposed to in a balance sheet where it's a moment in time. This is for a period of a year. So this is for years that are ending these moments in time. So if we just look at the first year, the September 29th, 2018, and the previous year, it shows us what the net sales were. And again, these are in millions. And then the cost of those sales. And then what's called a gross margin, which is the difference between what you sold and what that cost you. So they made $101 billion in gross margin. And then you take away from that any kind of other operating expense. In this case, they have the categories of research and development, selling and general and administrative expense, which totals $30 billion. From there, we get operating profit, which is the difference of 101 and 30, which is about $71 billion. In addition, there's another little expense other income expense of $2 billion that they add to that in order to get to income before taxes of almost $73 billion. Then they have the provision for income tax, which is the amount you pay the IRS. And then that gives us the bottom line income for the company, $59 billion. And usually they list more than 1 year. So in this case, you can see it's been increasing over time in 2016, 2017, and 2018. So the income statement tells you how much profit you've made. The next statement is the statement of cash flow, or what's also known as the sources and uses of funds. In this broad category, we look at, again, these are in millions, and it's also for a period of time. So this is for the last year, and it starts with the 3 categories, and the first is money that was generated in the company. So $77 billion was generated from operating activities. And then it looks at how you're going to spend that money. So you first are investing in it. So cash either generated or used by investing activities. Now, in the case of, you can see the category, it says generated by or used in. And this is a positive number, which means that it was generated by. So investing activities, this means that they actually divested from activities. They didn't invest in there, they divested. So they got money from selling items. And that's the way that they've used that. And then the next is financing activities. So how did they use their money in financing? So if we look, they got $77 billion. They got an additional $16 billion from selling items, and they take $87 billion of that, and they ended up buying back common stock. So what they did is they gave that money back to investors. So that's why it's called financing activities. And the way what we're going to look at is we look at what was the change in cash from one year to the next. This is like a checking account balance. Like, how did the checking account change from the beginning of period to the end of the period? So we get this beginning period from the balance sheet. So if you look again at the balance sheet, it says that in the beginning of 2018, which is the end of 2017, we had $20 billion. And then at the end of 2018, we had $25 billion. So we look at where did that $5 billion come from? And that's how we address the items. The other thing that you can get from the cash flow statement is it starts with net income. So remember, we talked about the profit that a company made. That's where we begin with the cash flow statement. That $59 billion, how did it change? How did it happen that we made $59 billion and yet we increased cash only $5 billion? What happened in between those things? And it tries to reconcile that. So those are the three reports that we're going to be reviewing, and in the idea of managing and understanding profits of the company.